Interest rates hit a 20-year high. Some great news from Fed Chairman Jerome Powell. What my observations and data is regarding what's going on in the housing market right now and mortgage products that are helping our clients win in a challenging market. I am Sean Panosian of Guaranteed Rate. I'm the #1 mortgage loan originator in the country over the course of the last 5 years, and this is our market update. Please feel free to follow us on LinkedIn or follow us on Instagram at Sean Panosian. We do these market updates, and we'd love to hear what you think, what you're seeing, and what information we should cover. As always, please feel free to share this or point people to our social media. If you're a home buyer or a home seller, I think it's some relevant information. If you're a real estate agent or financial professional, I think it's great information to have to disperse to all your clients so they know what's going on in housing right now. So let's get into interest rates. So interest rates, big headlines all week that interest rates, 30-year fix went up over 8%. Okay, that's the average 30-year fix in the country right now. And, it's been going all the way up from 6.5% to start this year. And obviously pretty far away now from the 2s and 3s from the pandemic related mortgage era. So what that means for your clients, housing payments are the highest they've ever been in the United States. Your average buyer has lost about $65,000 in buying power to start this year if you're a home buyer. So this is mostly due to a few things. You might be wondering, why do rates keep going up? Well, let me tell you. So mostly it's due to a hot economy. Stock market had a relatively great year. Consumer spending has remained very, very strong. We've had a growing economy and unemployment has remained really, really low. So in response to that, to cool things off, the Fed is in a quantitative tightening mode. Okay, they're increasing rates. They've raised rates 11 times since 2022 to fight inflation. They are letting their balance sheet run off. So they're flooding the market with things like treasuries and mortgage securities. They're not buying increased mortgage securities as well, which is a problem because they were the biggest buyer along with China of mortgage-backed securities and treasuries in the world. And you've got the two biggest buyers removing themselves from the market. But what we are seeing is some other buyers come into the market and getting some pretty good returns and yields on treasuries and mortgage-backed securities. So I believe that interest rates have peaked here right around 8%, maybe room to go up a little slightly higher. You never know what kind of information or news comes out. But I believe that what the Fed has been doing to slow down our economy is starting to make an impact as mortgage payments are up, car payments are up. You're starting to see a little bit of default, not in housing. Housing's remained actually really strong, but in other things like consumer credit cards and auto loans and whatnot. So there's some signs out there. In people's budgets, frankly, they're utilizing more of their income to pay their bills. So eventually that does slow down spending. But my observation is that I think that rates are peaked here, and I think we're going to start to get some relief into 2024 as my prediction is that rates will go down over the course of next year. Although I think if you're a buyer or a home buyer, it's time to act right now because there's less competition, which I'll share with you in a second. Inflation news. So here's some market movers. So the Fed's favorite measure of inflation, PCE and core, both came in lower, 3.4 to 3.7%. Now remember, inflation, depending on the report, was right around 9% in the summer of last year. So it's really made major progress. Okay, if you annualize this last 6 months of core inflation readings, it's at 2.8%. So still above the 2% target the Fed's aiming for, but we're well on our way to 2%. And remember, historically speaking, as inflation comes down, interest rates come down with it. So I think there's some positive news on the horizon as if inflation remains low, you'll see the 30-year fixed rate mortgage continue to come down. Fed Chairman Jerome Powell actually, for the first time in quite some time, acknowledged that there was some progress on inflation, that there's a glimmer of hope that he's actually kind of happy with it. So that was great. Unfortunately, we had gross domestic product come out, a report showing that our economy is growing by 4.9%. And that was a blockbuster reading. But consumers are spending on their credit cards like never before. Credit card debt in our country has never accelerated faster than it has over the course of last year. Credit card debt exceeded $1 trillion for the first time ever. And on top of that, the savings rate is going down fast. Your average U.S. taxpayer is only saving 3.4% of their income. So savings are getting dwindled. People are tapping into savings accounts, 401ks, IRAs, investments, and putting money on their credit cards. Okay, so eventually that will lead to a slowdown in spending. That's not a good mix. We also saw the European Central Bank pause on their rate hikes. Canada did the same thing. And I'm hoping that in November and December, you're going to see the Fed do the same and pause and let the work that they've done over the course of last year in terms of slowing down our economy with their quantitative tightening work and see if the progress on the reports starts to show itself over the course of the next couple months. So here's what it means for housing, and here's how housing is being impacted here in the fall market. So home prices are up about 5 to 6%, depending on the market, mostly due to a lack of supply. There's a lot of people not listing homes because they have rates in the 2s and 3s and don't want to participate in a higher rate environment. So they're staying put, making their current housing situation for them, enjoying their low mortgage payments. But this is a time of year where we typically see a reversal in home price appreciation. Last fall, we saw home prices come down anywhere from 2 to 4%, depending on the market. So starting to see a little bit of signs of that as demand's waned. Mortgage applications are down to a 29-year low. Okay, so here's what happens in mortgages. When rates were 3% in 2021 and early 2022, there was about 50 million eligible home buyers based on income and affordability. Every time rates go up by 1%, 5 million people take themselves out of the housing market due to affordability. So here we are today, 30-year fixed rate around 8%. There's only about 22 million people eligible for your average mortgage payment. So 28 million people have been removed by higher interest rates and affordability. Okay. Now there's still 22 million people that qualify, and only about less than 1 million homes for sale, and only about 560,000 single family homes. So still plenty of demand is what we're seeing because inventory is so low. Purchase applications are down about 2%, down about 22% year over year. So due to higher rates and lower inventory, a lot of times people won't apply for a mortgage if they don't see a house they like. Refinances, pretty low all year. They were low this time last year as well. Most of the refis that we're seeing some cash out for debt consolidation, paying off home equity lines of credit, divorce situations, cash out for home improvements. But really, refinance demand is really dwindled. As I think 80 or 85% of people in the United States that have a mortgage, that own a home, have mortgages under 4%. So with rates in the 7s and 8s, not a big refinance market. Pending home sales are down about 11%. New home sales, though, are up about 12%, and sales on new constructions are up 34% year over year. So a couple of reasons for that. Obviously, the demand for new construction and what people want out of housing, I think, has grown, and the way people live in their new houses and the space they want and the structure they want. But also the supply chain is also improving. So you're starting to see more completions. A lot of these houses that were starting to be built started 2 or 3 years ago. There's a lot of demand for new construction. One of the challenges of new construction is new construction loans on the builder side have really skyrocketed. So I do think you're going to see a slowdown of new construction starts into next year as interest rates have remained elevated. Typically this time of year, we see inventory fall off with the holiday season. Last year, the inventory peak was October of 2022. Remember, that's also when rates peaked for last year, and we really saw the market slow down. Right now, we have about 562,000 single family homes for sale, about 1 million total inventory. So super low levels. For context, in 2018 and 2019, prior to the pandemic, we had almost 1 million single family homes for sale versus the 562 that we have right now. So almost double the amount of single family homes in the market. However, still an intense market, seeing bidding wars on about a third of all new listings. Definitely starting to see some price adjustments accelerate. My advice to sellers is pricing smart is so important. Okay, because if you price smart, you're still going to get demand. You're still going to get an offer immediately. We're seeing that a lot of times. But if you miss price and try to hit a grand slam, property's going to sit on the market. Buyers are getting some relief. Starting to see my clients that have offers accepted. One, they're competing with way less people. Okay, less extreme bidding wars. Getting things like home inspections, mortgage contingencies, appraisal contingencies, negotiations, seller credits. All those things are back, and we saw the 40% of deals last year in the fall and winter markets had some sort of seller credit. We're starting to see those same things happen now. So if you're a home buyer, really want to get into the housing market, this is one of the best times to buy and actually win your offer than it has been in a very long time. Remember, in 2020, 2021, when rates are super low, it was virtually impossible to get your offer accepted. So what we're seeing win in this market, huge challenge is affordability as home prices are up and interest rates up. Temporary buy downs and permanent buy downs. 2-1 buy down is a temporary buy down product that's been super popular. You can also do things like 3-2-1, 1-0. All that means is you get a discounted rate and huge savings over the course of the first 1, 2, or 3 years. And then there's permanent buy down options where you can buy your rate down permanently. Now, I know I'm talking technical, so it's something that I can help you with. So please reach out direct and we can dive into that. Also, adjustable rate mortgage products have remained super popular as well. But the challenge right now for home buyers and even home sellers, because we're having a lot of listing agents reach out to us to put together options for potential buyers on their properties. It's all about figuring out the affordability challenges. And that's what we're really great at. We're advising and really just kind of coaching our clients through all the different options out there that they normally would not know to ask for, showing them how they can save interest, save money, and also set themselves up to refinance in the future when rates come down. Please feel free to share this with anybody in your network, any potential clients, friends, family, coworkers. I would really appreciate it. If you have any questions or observations, please reach out to me directly, direct message me, or email me at shant@rate.com. Again, I'm Shant at Guaranteed Rate, the number one mortgage lender in the country. This is our market update for Halloween, October 31st. Happy Halloween. Hope everybody has some fun tonight with their families. And we'll be back next week with another market update. Thanks, everybody.